850. That's the score on the screen of the guy who just got denied for the loan he actually needed. Perfect score. Zero approval. And 2 hours later, the bank across the street hands $40,000 to someone with a 720. Not a typo. Not a glitch. This happens every single day to people who did everything right. Here's what you were told. Get your score as high as you can, and the money follows. Doors open. Rates drop. You've made it. Here's what's actually true. Past a certain point, your score stops being the thing lenders even look at. Think of it like a job application. Your score is your resume. It shows what you've done in the past. But the bank also wants to know one more thing. Can you actually handle this new bill right now, today? That second question uses a totally different number, one most people never check. By the end of this video, you'll know exactly what that number is, why it's quietly deciding your approvals instead of your score, and why chasing 850 might be costing you money you'll never even see disappear. You check your score on a Tuesday morning. 850, the absolute ceiling. You feel it in your chest, that quiet, smug relief. I'm untouchable now. Here's the first number that should bother you. Only about 1.7% of people ever reach 850, which sounds like a win. It isn't. It's a sign you spent years chasing a target most lenders stopped caring about a long time ago. The average American score right now sits at 714. That's dead center of good, nowhere near the top. Nearly half of all people, 48%, already sit at 750 or higher. And here's the part almost nobody tells you before you go chasing those last 100 points. Once you cross roughly 760, lenders stop treating you any differently. Not at 800, not at 850. Think of it like a job interview. Once you clearly show up on time, dressed well, and ready to work, showing up even earlier the next time doesn't get you a better job offer. The interviewer already checked that box. Your score works the same way. The rate you get at 780 and the rate you get at 850 are, in most cases, exactly the same. So you spent years closing old accounts, watching your spending down to the dollar, chasing a number that stopped moving the needle 100 points ago. That's not you failing. That's a trap built into how this number gets sold to you. And it's about to get worse before it gets better, because the guy from the start of this video, the one with 850 who still got denied, he's not some rare case. He's about to become the new normal. So why does a perfect score get denied? Here's the part nobody explains to you as an adult. Your credit score only looks backward. Did you pay on time? Did you keep your balances low? Did you avoid opening 10 cards in a panic? It's like a report card from a class you already finished. It says nothing, literally nothing, about whether you can afford new debt today. That's a completely different question. It has its own number called debt-to-income ratio, or DTI for short. Think of DTI like a plate at a buffet. Your income is the size of the plate. Your monthly debts, your car payment, your student loan, your credit cards, are the food already piled on it. DTI just measures how much room is left before the plate is full. And DTI is the number quietly running the whole show behind every score you've ever chased. Your score answers one question. Has this person been responsible in the past? Your DTI answers a totally different question. Can this person actually handle one more payment right now? Lenders need both questions answered before they hand you money. But only one of those numbers shows up on your phone. The other one, the one that actually blocks your approval, stays invisible unless you go dig it up yourself. That's the whole trap in one sentence. You've been polishing the number you can see, while the number you can't see was quietly deciding your fate the entire time. Most banks draw a hard line around 43% DTI for a regular mortgage. Cross that line, and it doesn't matter what your score says. The door is shut, full stop. An 850 score sitting next to a 55% DTI loses to a 720 score sitting next to a 30% DTI. Every single time. That's not a bank being cruel or picky. That's a bank running math you were simply never shown. So if your score was never the real gatekeeper, the next question is obvious. What does this invisible number actually look like once you drag it out into the light? The belief you grew up with is simple. The higher the score, the better the treatment. Here's the number that breaks it apart. A 34-point gap. Sounds huge. It barely mattered. Back in 2013, a mortgage data company called Ellie Mae tracked who got approved for regular home loans and who got turned away. The average denied borrower had a score of 724, solidly good by any measure. The average approved borrower had a score of 758. That's the 34-point gap, and it explains almost nothing, because the denied group had a real problem hiding underneath their score, a 47% debt-to-income ratio. Remember, that's the plate we talked about, and their plate was almost full. The approved group sat at 34%. A 13-point gap in debt mattered more than a 34-point gap in score. Read that again if you need to. The score barely told them apart. The debt is what actually separated them. So here's the myth, said plainly. A higher score always wins. And here's exactly what kills that myth. A bank will approve a lower score with clean, manageable monthly bills over a higher score buried under payments, without blinking every single time. Your 850 was never a golden ticket. Go back to that resume from the start of this video. It's proof you behaved well in the past. But the bank isn't trying to reward your past. It's trying to guess what happens to your bank account next month. And no resume, no matter how spotless, can answer that question for them. So if the score you've been chasing your whole life was never built to answer the one question that actually matters, what number were the approved people actually watching instead? Let's put a real number on what this actually costs you, because you might get denied doesn't hit until you see the math. Say you spent 3 years chasing that last stretch, going from 760 all the way to 850. You close your oldest card because you thought fewer accounts looked cleaner. You refuse to ever carry a small balance, even the kind that actually helps your file. You turned down a store card that would have made your credit history look stronger, just to avoid one small check on your file. None of that grew your net worth by a single dollar. It just moved a number that had already maxed out 90 points earlier. Now, picture a different version of you. Same 3 years, but instead of chasing the score, you point every spare dollar at debt. You kill a $400 a month car payment. You wipe out a credit card balance charging 22% interest. That one move, killing a $400 monthly bill, does more than save you interest. It shrinks your DTI by real, meaningful percentage points. On a $300,000 mortgage, the difference between getting approved and getting denied often comes down to exactly that. One canceled payment. Not one extra credit check avoided. There's one more angle to this cost that almost never gets said out loud. Take that same 22% interest credit card sitting at a $5,000 balance. Make only the minimum payment, the way most people quietly do for years, And it can take well over a decade to clear, with the bank collecting nearly as much in interest as the original balance itself. That's not a rounding error. That's a second car sitting invisible inside one revolving balance, while you were busy protecting a score that already cleared the bar 90 points ago. Here's the smaller version of this same story, the one that hits almost everyone watching, not just future homebuyers. Say you're renting and you want to move into a nicer apartment next year. Landlords run this same DTI-style math, just with a friendlier name. A $400 car payment you could have killed instead of chasing your score is the same $400 quietly capping which apartments will even approve your application. The trap doesn't wait for a mortgage to cost you something. It shows up on the very next lease. Now here's the brutal version. Picture a first-time buyer denied because their DTI sits at 43%. Instead of paying down that debt, they spend 2 years chasing score points instead. They don't just lose 2 years of owning a home. At an average 6% mortgage rate, waiting 2 years to buy a $350,000 home, while rents and home prices creep up even a little, commonly adds $20,000 to $40,000 to what they'll eventually have to borrow. That's the invisible bill for polishing the visible number. Nobody mails you that invoice. It just quietly attaches itself to your future, one missed year at a time. And here's the part that stings the most. That money didn't just disappear. It went somewhere. Every dollar spent keeping a card balance at 0% utilization instead of going toward debt, every year spent waiting on a denial instead of already owning, is a dollar in a year that could have gone into an index fund, a down payment, a business, anything actually building your future instead of decorating an app. The cost was never really about interest rates or closing dates. It was about where your money and your time were pointed the entire time. So if chasing the score cost that much, what exactly were the people who got approved doing with their time instead? So what are the people who do get approved at every income level actually doing differently? They're not smarter than you. They just stopped playing the wrong game. They're not chasing 850. Most of them don't even know their exact score down to the digit. What they know cold is their DTI because they calculated it themselves before they ever walked into a bank. The lending data backs this up again and again across every type of loan. Approved borrowers show up with scores all over the place. High 600s all the way to low 800s, a wide and forgiving range. But on DTI, they cluster tight, almost always under 36%. That's the real target you should be aiming for. Not the ceiling on your score, the floor under your monthly bills. The people getting approved for the loans, the cards, the rates you actually want are doing one unglamorous thing. They're keeping their monthly debt small compared to what they bring home. And they're leaving their score right where it already clears the bar, usually somewhere in the 700s, instead of grinding for extra points that changed nothing. They stopped polishing the number the bank barely glances at and started managing the one it checks every single time. So now you know the real target. The only question left is what you actually do with that information, starting today. Here's the actual sequence to follow. Do these in order because each one clears the way for the next. Step 1. Calculate your real DTI today. Add up every monthly debt payment you have. Your car, your credit cards, your student loans, any personal loans. Divide that total by your gross monthly income, the amount you make before taxes come out. That percentage is the number actually getting your next approval. Most people have never once run this simple calculation, and it takes under 5 minutes with numbers you already have sitting in your banking app. Write the number down somewhere you'll actually see it again, a note on your phone, a sticky note on your monitor. This is the number the rest of this list is built around. Step 2. Stop optimizing past 760. If your score already sits above, roughly, 760, stop right there. Every hour you spend chasing it higher is an hour you didn't spend lowering your DTI, the number actually standing in your way. If you're below 760, keep building it. That part still matters. Past it, it's just noise. Redirect that same energy, the same discipline that got you to 760 in the first place, straight at your DTI instead. Same effort, completely different payoff. Step 3. Kill the highest interest, highest payment debt first, not the smallest balance. Most advice tells you to start small for motivation. But for approval, the debt with the biggest monthly payment is the one dragging your DTI down the hardest. Go after that one first, even if the balance looks scarier on paper. It's the payment that matters to a lender, not the total owed. Killing one $400 payment moves your DTI more than closing 3 small balances ever will. Step 4. Never close your oldest account just to clean up your file. Closing it shortens your credit history and can actually lower your score for no good reason. Let it sit open, even in used if you want. It costs you nothing sitting there, and it's quietly working in your favor the whole time. Step 5. Before any major application, get pre-qualified, not just pre-approved. A pre-qualification check lets a lender estimate your DTI base ceiling without a hard mark on your file, so you learn the real number before it ever costs you anything. Most people skip this step and find out their real ceiling the hard way, after a denial already shows up on record. 10 minutes of pre-qualifying can save you a wasted application and a hard inquiry you didn't need. Step 6. Time your large purchases around your DTI, not your score. A new car loan taken out 2 months before a mortgage application can push your DTI over the line, even with an untouched 800-plus score sitting right there. Sequence your debt, not just your credit checks. If a big purchase can wait 6 months, let it wait until after the application that actually matters more. The order you take on debt matters just as much as how much debt you take on. Step 7. If you're ever denied, ask for the adverse action notice. By law, the lender has to tell you why. Most denials point to DTI or income, not score, and reading it tells you exactly which number to fix instead of guessing in the dark. This one document turns a confusing rejection into a clear next step, instead of a mystery you're left to solve on your own. 7 steps. Notice not one of them mentions chasing a higher number on your app. Every single one is about the number the app never even shows you. None of these steps are complicated. None of them require a finance degree or a lucky break. That's the part that should actually make you angry in a useful way. This information isn't hidden because it's hard. It's hidden because nobody profits from you knowing it. The score tracking industry sells you dashboards and alerts and celebration emojis every time your number ticks up a point. Nobody sends you a push notification for lowering your DTI, even though that's the number quietly deciding whether any of it ever turns into an actual approval. And once you've followed all 7, there's still one more thing worth seeing. What this actually looks like when it plays out for 2 real people side by side. Picture 2 co-workers, same department, same salary, both applying for auto loans in the same month. The first one spent 4 years protecting an 850, never missed a payment, not once. He closed 2 of his oldest cards because a blog told him fewer accounts look more responsible. He still carries a car payment, a personal loan from a kitchen remodel, and student loans that never quite shrink. His DTI, if he'd ever bother to check it, sits at 48%, nearly full. He applies. He waits. The email comes back, denied. He rereads it twice, sure it's a mistake because his score has been perfect for years. He stares at his score, genuinely confused, because nobody ever told him the number staring back at him wasn't the one that mattered. The second coworker has it as 730. Solidly good, nothing flashy. But 2 years ago, she ran the DTI math herself. She saw a $380 car payment eating a huge slice of her paycheck, and she paid the car off 8 months early instead of chasing extra score points she didn't even need. Her DTI sits at 24%, plenty of room left. She applied the same week, same lender. Approved in under an hour, with a better rate sitting right there on the table. Same income, same starting point. The only real difference was which number each of them decided was worth their attention. He walks away thinking the whole system is broken. She walks away without a second thought, because for her, it already made perfect sense. So if the same starting point can lead to 2 completely different outcomes, what does that actually mean for the number you've been chasing this whole time? Go back to that phone screen from the very start. 850 glowing maxed all the way out. It was never a broken system. It was a number doing exactly what it was built to do, just not the job you were told it had. Your credit score was never the actual goal. It was never supposed to be the goal. The real goal was always approval, real access to the mortgage, the rate, the freedom to move when life asks you to move. And that approval was quietly being decided by a number sitting one folder over the whole time. So here's the one thing to actually do today, not someday. Open a calculator, add up your monthly debts, divide by your gross monthly income. That's it. That's your real score. If it comes out on a 36%, you're already standing in a room the 850 chasers spent years trying to break into. If it's higher, now you know exactly what to work on. Not your score, your ratio. Next time someone brags about their perfect 850, think about the guy in the bank lobby. The number on his screen was flawless. It just wasn't the one anyone was actually asking for. And most people never find that out. Not until it's already cost them years. If you've never calculated your DTI before, drop your number in the comments. No judgment, just data. Subscribe if you want the next breakdown on exactly how to bring that ratio down fast. That's coming soon.